everyone. Welcome to this episode of Take Charge Now. Are you optimistic about investing? It might depend on where you live in Canada. The latest data from Edward Jones reveals a diverse investment sentiment right across the country. While 43% are very optimistic about the current climate, a significant 40% hold a negative outlook, leaving about 17% unsure if now's the time to invest. Regionally, Quebecers are very positive, while Albertans remain hesitant. Now, the reasons are apparent. High inflation and high interest rates have challenged many Canadians. Yet when it comes to investing, I have a few rules that I think apply. Here are my top 3. Invest in stocks for the long run. Investing in equity markets comes down to timing. Yeah, I know, I don't often say that, but if you are likely to need the money in the next few years and are looking for financial stability, consider another investment option. The markets are volatile and there are no guarantees your capital investment will be there when needed. It's helpful to ask yourself 3 questions. How much am I prepared to invest long term? What reasonable rate of return can I expect from my investment? And how long am I prepared to invest? The second rule, know your risk tolerance. Your income, your net worth, your education, even your age often influence risk tolerance. How you feel about risk and the degree of anxiety you feel when risk is present is personal. If you're a younger investor looking to create wealth, have a long-term horizon, you may react very differently than someone who is a little older and in wealth preservation mode. When it comes to risk, ask yourself, how much am I willing to lose and how much can I afford to lose? Would I risk $100 to gain $1,000? It isn't right or wrong. It's all about how you would respond to potential outcomes and knowing where you draw the line. And 3, don't forget to diversify your investments. Pay attention to the power of diversification. Savvy investors don't only invest in one country, one industry, one sector, one currency. It all comes down to asset allocation. Asset allocation divides your risk across significant categories such as cash and bonds and stocks, even real estate. Each class has its own level of risk and behaves differently depending on market conditions. So if stocks go higher while bonds go lower, there's a little protection in your portfolio. Take the time to figure out how much of your money you're willing to dedicate to each category before deciding which specific asset class to invest in.